In this corner, professional fund managers, Ivy League degrees, million-dollar salaries, teams of analysts, information you'll never have, and one full-time job. Beat the market. And in this corner, a list. Not a genius, not an algorithm. Literally a list of 500 big American companies that rebalances itself and charges almost nothing. Over any long stretch, the list wins about 92% of the time. 9 out of 10 of the smartest, best-paid investors on Earth lose to a piece of paper. Today, what this list actually is, what happens inside the machine that maintains it, the real reasons the pros can't beat it, including one reason nobody in the industry wants to say out loud, what's true about the few who do win, and the honest catches you should know before you bet your future on it. Ding ding. First, what this thing actually is. The S&P 500 is an index, a maintained list of roughly 500 of the largest public companies in America, the tech giants, the banks, the retailers, the pharma and energy majors. Together, they represent around 80% of the entire U.S. stock market's value. Two mechanics make the list special. One, it's weighted by size. The bigger the company, the bigger its slice of the index. Two, it's self-cleaning. Companies that fade get dropped. Risers take their place. No emotion, no loyalty, no press conference. Read that back. Automatically holds the winners. Automatically trims the losers forever for a fee near zero. That's not a passive list. That's a ruthless system wearing a boring costume. And when you buy an S&P 500 index fund, that system works for you. So who actually runs this list? Pull back the curtain and it's almost disappointingly unglamorous, which is exactly the point. The index is maintained by a small committee at a ratings company, working from published criteria. A company must be US-based, large enough to clear a market value threshold, consistently profitable, and have shares that trade freely and liquidly. Meet the bar, and you're eligible. Fade below it, and you're out. It's less like stock picking and more like running a library card catalog. The weighting takes zero committee effort at all. It's automatic. Because the index weights by market value, when a company grows, its slice of the index grows by itself. When it shrinks, its slice shrinks. Nobody has to decide to buy more of the winner. The math does it continuously. The committee mostly just handles the door. A few companies enter and exit each year, with changes announced on a schedule. Why should you care about this plumbing? Because it answers the beginner's quiet worry. What if the people running my fund make a bad call? There's barely a call to make. No forecasts, no conviction bets, no star manager having a bad divorce. The system is criteria plus arithmetic. And, as tomorrow's fee gremlin taught us, systems with fewer human decisions have fewer human fees and fewer human mistakes. The boringness isn't a bug, it's the moat. Now the receipts. Independent scorecards have compared actively managed funds against their benchmark index for decades. The best known is the SPIVA report, which has run since 2002. The findings are so consistent, they're almost boring. Over 15-year periods, the share of U.S. large company fund managers who fail to beat the S&P 500 has repeatedly landed around 90%, some periods better, some worse, which is why you'll hear 88, 92, 95, depending on the window. The exact digit moves. The verdict never does. The overwhelming majority of professionals over meaningful time horizons lose to the list. And here's the killer detail buried in those reports. The few who do win rarely repeat. Today's table-topping manager is statistically unlikely to still be on top 5 years from now, which means even if beating the market is possible, identifying who'll do it in advance is the part nobody has cracked. You're not picking a winner, you're picking a lottery ticket that charges 1% a year. Let me show you the self-cleaning mechanism in action because it's the most underrated feature of the whole machine. Walk through the index graveyard. Film companies that missed digital. Phone giants that missed the smartphone. Retail empires that missed the internet. Household names that once looked permanent. Every one of them was a top holding in its day, and every one of them faded out of the index as it shrank, replaced automatically by whatever was rising. Now here's the question that should stop you. If you had handpicked a portfolio of the safest, greatest companies in America at almost any point in history and just held those forever, you'd have ridden several of them into that graveyard. The average company doesn't stay great for 50 years. The list stays great precisely because it doesn't stay loyal. This is why owning the index beats owning even an excellent snapshot of the index. A snapshot ages, the machine molts. Whoever the giants of 2050 turn out to be, companies that may not exist yet, the index will own them automatically without you reading a single earnings report. You're not betting on any company. You're betting that something will grow. That's the safest bet economics offers. So, why do trained professionals lose to a list? Not stupidity. Structure. 3 reasons. Reason 1, the toll gate. The index charges nearly nothing. Active funds typically charge around 1% a year plus trading costs. Every year, win or lose. A manager doesn't need to match the market. They need to beat it by their whole fee stack just to tie. Over decades, that hurdle is a mountain. Reason 2, the deep one. The professionals are the market. Big institutions do the overwhelming majority of all trading. The market average isn't the average of amateurs. It's mostly the average of the pros themselves. By definition, after costs, the average professional must underperform the average. It's not a skills gap, it's arithmetic with a toll booth. Reason 3, the one the industry hates saying out loud, career risk. A manager who deviates boldly from the index and fails gets fired. One who hugs the index keeps their job either way. So many funds quietly mirror the index while charging active fees. There's even a name for it, closet indexing. You pay for a fighter and receive the list at 30 times the price. Fair question. What about the winners? Some managers really do beat the index over long periods. They exist. 3 honest things about them. First, you can't identify them in advance. Past winners cluster no better than chance in the future scorecards. By the time a manager has a famous track record, the outperformance is usually behind them, and their fund is too big to repeat it. Second, even the greatest stock picker alive tells you not to try. Warren Buffett has instructed that his own family's inheritance be put in, his words, a low-cost S&P 500 index fund. And he backed it with money, a famous $1 million 10-year public bet that a plain index fund would beat a hand-picked collection of hedge funds. The index won. It wasn't close. Third, and this is the part to internalize, even if you could find next decade's winning manager, your expected edge is small, your fee is certain, and your odds are roughly 1 in 10. Nobody rational takes a 90% chance of losing for a modest prize. The existence of lottery winners doesn't make lottery tickets a plan. Own the list. Follow the logic to its uncomfortable end. If the best resourced investors on earth can't reliably beat the market, the strategy of trying to out-trade them from your phone between meetings is not a plan. It's a donation. The winning move is almost offensively simple. Stop competing. Own the whole market through the index, pay near zero fees, and collect the average, because the average that 92% of professionals can't beat is, by definition, an elite result. Average is the podium here. This is also yesterday's fee math wearing a new outfit. 1% to a manager who statistically won't earn it can quietly consume a quarter of your lifetime wealth. Boring and cheap beats brilliant and expensive. Not sometimes, structurally. Practical question before the catches. When you go to actually buy, you'll face 2 baskets, the S&P 500 or a total market fund holding thousands of companies including the small ones. Which? Here's the honest answer that finance channels drag into 20 minutes. It barely matters. Because the index weights by size, the giant companies dominate both baskets. The total market fund is roughly 4/5 the same holdings, and the 2 lines have tracked each other almost identically for decades. The total market version adds a sprinkle of small and mid-sized companies, a bit more own everything purity, a chance to catch tomorrow's giants slightly earlier. So either is an excellent answer, both beat the pros, and the worst decision is spending 3 weeks deciding. If you want a rule, total market is the slightly more complete haystack. The S&P 500 is the classic. Pick one, check the expense ratio is tiny, automate the buying, and never think about this question again. The expensive mistake was never choosing the wrong basket. It was standing in the aisle holding neither. Now the catch is, because this channel praises the index, but it doesn't sell it blindfolded. 3 honest ones. Catch 1, concentration. Because the index weights by size, the 10 biggest companies can make up a third or more of the whole thing. When tech giants sneeze, your diversified fund catches the cold. You own 500 companies, but not equally. Catch 2, it's an all-in bet on America, thriving so far, but a total world index fund spreads the bet across every major economy, and plenty of smart investors hold exactly that instead. Either is defensible, know which bet you're making. Catch 3, the flat decades. From 2000 to about 2013, the S&P went essentially nowhere, 13 years. Investors who kept automatically buying through that desert were rewarded enormously in the decade after. Investors who quit in year 7 locked in the disappointment. The index demands the one price many people can't pay, staying in the game when the game looks broken. That's the real fee, and it's emotional, not financial. Quick answer to the question every new index investor eventually Googles at midnight. Wait, do I actually get any money from this thing? Or is it all just numbers going up? You get money. Here's the 90-second version. Hundreds of the companies in the index share profits directly with owners, dividends. The concept from our very first investing lesson. Own the index and those payments flow through to you, typically landing every quarter. The current yield on the S&P has recently run around 1 to 1.5% a year. Real cash deposited into your account, on top of the price growth we've discussed all week. It's not the headline attraction, but it's never been decorative either. Reinvested dividends account for a massive share of the market's total long-run return. The century chart you saw earlier, a big slice of its climb is dividends quietly recycling. Which brings us to the one setting that matters, the reinvestment toggle. Every brokerage offers automatic dividend reinvestment, usually called DRIP, where each payout instantly buys more shares of the same fund, including fractions. Those new shares pay their own dividends, which buy more shares, which, you know this machine. It's the coin family tree running on autopilot inside your account. For anyone in the building years, toggle on, always, and forget it exists. Later in life, the same tap becomes something beautiful. Retirees flip the toggle off and let the dividends land as spendable income. The portfolio literally starts paying a quarterly salary without selling a single share. Same list, same tap. You just stop recycling the water. One more reason the boring basket beats the exciting story. Stories don't pay quarterly. Ownership does. The case closed. The S&P 500 is a self-cleaning list run by criteria and arithmetic, not genius. The scorecards show roughly 9 in 10 professionals fail to beat it over long periods, and the winners can't be identified in advance, which is why even Buffett points his own family at the index. The pros lose because of fees, because they are the market, and because their careers reward hugging the list anyway. S&P, or total market, pick either, pay pennies, accept the elite result called average, with eyes open about concentration, the America bet, and the occasional lost decade. One question left, and it's the one that stops most people from ever starting. Sure, but what difference can my money make? I don't have thousands to invest. Tomorrow, I take $100 a month, coffee money, and run it through the real math, year by year, decade by decade, including what happens if the market crashes right after you start. The ending genuinely surprises people. Subscribe and come watch $100 embarrass every excuse you've ever heard, including yours. See you tomorrow.